Jeff, investors get really interested when companies split their stocks. A lot of times it's because it's companies that are already popular and also companies that generally their stocks have gone up a ton. That's usually why they end up getting split.
Yeah, it's usually a bullish signal when a company splits their stock. They're doing it for good reason, and it gets investors excited for some good reasons and some not so great reasons.
Yeah, we'll talk a little bit about both of those. The main thing is that we each have a stock we're going to talk about that we think is a future stock split stock. At some point, those big 3-digit and in one case 4-digit stocks are going to get turned into a lot more shares. I'm Jason Hall. This is Investing Unscripted. Jeff Santoro, my partner, is on here with me today. Before we get into our two stocks that we want to talk about, though, this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, you should check out our special link. It's fool.com/unscripted. Go to that link and you can get access to The Motley Fool's 10 best stocks to buy right now. Okay, Jeff, before we get into our stocks, though, let's talk about what a stock split is, what it means, and what it doesn't mean.
So it means exactly what it sounds like. The stock gets split into smaller pieces, but it's really important to remember, and this is the piece that investors often get confused by. It does not change your economic stake in the company. The analogy everyone uses is a pizza, right? If you slice a pizza 8 ways or 16 ways, and you take one of the eighth slices or two of the 16th slices, it's the same amount of pizza.
People get grumpy in the comments when we use the pizza analogy.
That's
So
why I
I'm
did
going to
it.
use I'm going to use brownies.
All
I'm going to
right.
say brownies. You can have a pan of brownies and you have the same amount of brownies in the pan, no matter how many pieces you cut it into, right?
Right.
If you start with one brownie and there's 12 in the pan and everybody's brownie gets cut into 4, now there's 48 brownies, but you have the same percentage of the pan of brownies unless you steal your brother's brownies when he's not looking. But, that's
But
brownies. We're talking about stock splits.
But there is a benefit for some people. If you don't have access to a brokerage that allows you to buy fractional shares,
Yep.
or if you just don't like to have fractional shares, you just like to have
Mhm.
whole numbers, it really can help. A stock that, for example, the stock I'm going to talk about, Mercado Libre, currently trades for more than $2,000 a share. If they were to split 10 to 1, now you're talking $200 a share, much more affordable if you're just buying whole shares. So it's not all bad news. There is some good reasons for it, but we wanted to level set people's expectations.
Yeah, I don't think bad news is the best way to describe it, just kind of nothing burgers.
Yeah.
But that's the key thing is that, sometimes those of us that have that use brokerages that let us do fractional shares, forget that like Schwab, for example, if it's not an S&P 500 stock, you can't buy fractional shares. Guess what, Jeff? I think neither of the two companies that we're talking about are in the S&P 500 because neither of them are US based companies, right? So those are factors that can come into play.
So I mentioned mine is Mercado Libre, and let's dive into that a little bit. So Mercado Libre, I know the Amazon of XYZ gets overused a lot, but Mercado Libre is primarily a e-commerce company that is focused in Latin America. It also has a big fintech part of the business. So it's almost like if you took Amazon and something like PayPal and mashed them together, that's the core of their business. The best way I can sum up the reason I'm so bullish on this stock, whether it splits or not, is because every single quarter results come out and the results are ridiculously impressive. They grow revenue at high double digit rates every single quarter. The profitability increases. They generate a ton of cash. And when you drill down to the segment level data, it's just really impressive. So here's some examples here, Jason. Gross merchandise volume, which is just the total dollar amount of all of the merchandise that comes across their platform. If you back out currency issues, it was up 83% in their last reported quarter. And that's not abnormal, that level of growth. That's not an outlier. Total items sold up 30%. On the fintech side, total payment volume, which again is just the total amount of dollars that come across its payment networks, again, adjusting for currency fluctuations, that was up 86%. So those are just a couple quick examples, but that's pretty much what you get every single quarter with Mercado Libre. And with all of that crazy growth, the stock isn't really super expensive. I wouldn't call it cheap, but there are certainly less strong businesses out there that trade for much higher multiples. And the track record, I think, speaks for itself. So whether or not this stock ever does split, we'll find out. There's no news of that right now. But either way, I think this company is absolutely worth owning.
Yeah, I agree 100%. That's my largest investment. My largest holding is Mercado Libre stock. I have no expectation of lowering that either for exactly the reasons that you said. I will say if there's one kind of caution sign that I'm focusing on thinking about a risk with Mercado Libre is part of their fintech business is lending. Lending in Latin America and different countries in Latin America can be challenging. Seems like they have pretty good expertise, but it is risk, right? When you're moving into lending and not just providing a transactional tool as their payments platform primarily is, and selling stuff and building warehouses to deliver on e-commerce. So there's a little bit of risk there, but I think by and large, I agree. They're nobody's even close to them in the countries they operate in Latin America. I'm going to go in a very different direction with one caveat. That caveat is that everybody that interacts with Mercado Libre relies on this company's products because they're using the chips in their smartphone or on their computer to get to it. The company that I'm talking about is ASML, which I think is maybe the most important company in the semiconductor industry, more important than Taiwan Semiconductor, more important even than NVIDIA, because, well, without ASML's machines, all of the GPUs that are driving the AI advancement, the CPUs, the chips in your smartphones, everything getting smaller and faster and lower power, are powered because of ASML's investments, billions of dollars over multiple decades for the machines that do the lithography, which is basically painting the chips onto the silicon and making them smaller and faster and better. Nobody is even close to where they are. And it unlocks all of that power. Now, recently, Jeff, we've seen a couple of things happen. They have a massive order book, but we've actually seen their earnings start to come down a little bit for a couple of reasons. Cost overrun, or not, I shouldn't say overruns, but high costs, a little bit of slowing of growth demand. It's still very strong and the pipeline is growing, but it's moderated a little bit. Some challenges with China because of some tariffs that have been put in some place and some beyond the tariffs restrictions on machines that can be imported into China that have been an issue. And more recently, China has threatened to stop using ASMLs. The government's pushed back, and there's kind of some saber rattling that's happened. There's challenges from Western countries about more and more limits there. Overall, that's pushed the stock down maybe 25, 28% from the high. It's still not cheap.
No.
But if you look at how much the stock has come down, factoring for the adjustment in earnings that's come down, the PE ratio has come down even more, right? So it's getting close to me to looking like a better value. Again, this is not one that's never going to be a value, but I think we've got a really, really good opportunity to buy just a wonderful business at a much better price than we could have bought it really just about any time for most of the past year or so.
Yeah. And I think it's important to remember that the semiconductor industry is cyclical, and that's going to impact ASML also. And you wouldn't intuitively know that we're actually still in the down part of the cycle because all of the news has been around the chips that people are rushing to buy for AI. But if you
Right.
take the AI rush out of the picture, the rest of the semiconductor industry is still in a cyclical downturn. And the thing about ASML is they use those opportunities to plow money into research and development while they have a backlog so that when the
Yeah.
demand returns, they're ready. So if you read their management commentary, it's all about how they know this year is going to be what it is. And
Right.
2025, they expect to return to growth. And if that happens, you won't see this approaching cheap PE multiple anymore. It will almost certainly rise back up.
That's right. We're still in the very beginning phases of their EUV. It's extreme ultraviolet. Those machines, we're still in the very early phase of those machines even being deployed. Historically, this is a stock, if you look over really most of the past year, the stock traded for above $900 a share. It's below 800 at recent prices as we record this. So I think this is definitely a time to be looking at building out a position or adding to a position in ASML.